Now, the president today saying he likely won't fire Powell, but does continue to call for lower rates. Joining us to discuss is former NEC director and former Fed Governor Larry Lindsey. Larry, it's great to see you. Welcome back.
It's great to be here. Thank you.
What do you think a full review of the Fed means?
Well, what I think it means is they want to check on whether they're doing their job. And I don't think they have to scratch the surface very far to find out that they really haven't done a very good job. You know, here was the test that I actually just conducted. Suppose we took the December FOMC statement, summary of economic projections, and you compare that to what actually happened. So remember, this is December, just looking forward 1 year. The average error since they started collecting these was 1.1%. The target they're shooting for is 2%. That means their average error was 55% of the number that they were shooting for. That's a huge error. And even worse, if back in 2007, you had just simply written down the number 2 for all of the following years coming up to the present, you would have had a much lower error than what the Fed actually did. In other words, the value added or the productivity of all the Fed's efforts was negative.
So all of that said, Larry, there's two questions I have. One is, and look, they've tried for years to figure out how to make the Fed more forward-looking, more predictive. It's a tough business. Everyone's trying to predict markets every day. They don't seem any better at it than kind of the average. That's one piece of this. The other piece is, when he says the Fed is an institution, is he talking about something broader than just running monetary policy, or do you think that's really all we're talking about here?
No, I think it's broader. I mean, are they doing well? If you look back at the Silicon Valley Bank failure, you had the head of the bank sitting on the San Francisco Fed board until the day before the bank was closed. They had 23 different memos from the supervisory staff going up that were ignored. I mean, this is just not the way to run a railroad. And I think it's important that we get the facts out and that we make a decision whether things are going the way we want and what we can do to change them.
We've heard different proposals over the years about, do they need, more people from the business world, or do they need, I don't know, to consider market factors more? And then they now have the framework review every few years where they try to continually, there's kind of reminds me when you bring in the consultants. You're like, there's something at this company, it's not executing that well. Let's bring in the consultants. And then it just kind of, it's not clear that anything really improves over time. So what is there really to be done to this core question of kind of how do you predict the future? How do you see around corners, especially at this ironic moment where a lot of people who were critical of the Fed the last couple of years, and especially in 2022, my goodness, are now saying, all right, for right now, they've kind of done a pretty good job steering through this period of time.
Well, again, they're doing worse than what they would do if they had simply picked a 2% number as far as projections go. They completely missed the uptick in inflation in 2021, which was a big mistake. Their September move got a loud Bronx cheer from the bond market, right? They cut 50 bips in September, and within a month or so, the 10-year bond was up 60 bips. That's certainly a signal that they weren't doing the right thing. So I disagree with those who say that, they're doing fine. It's a tough job. There's no question about it. No one expects perfection. But this is, again, the productivity of all of their contributions has been negative since 2007 when they first began.